Hello everybody, this is Rudra Pradhan here. Welcome to BMD lecture series. Today we will continue with the decision analytics, and the topic of discussion is the value of information and utility theory. We have already discussed couple of problems where we need actually decision making process through which you can address the business problems as per the particular requirement. We have analyzed various business problems by using different decision making criteria like a aggressive strategy, conservative strategy, and also we try to visualize all these outcomes corresponding to the particular business requirement through a concept called as decision tree. So, that means we have discussed several criteria, several structure through which we can bring the business problems in a kind of environment where we can pick up a particular outcome as per the particular business requirement. So, now to add value to this particular process, so we like to address two different components. One particular component is called as value of information, and the second one is called as utility theory. So, now how the value of information and utility theory will again help us to analyze the business problems and then come with a kind of decision making process through which we can visualize the business problem more effectively and more accurately. So, in the case of value of information, the particular concept which you like to target is called as EVPI, that is the expected value of perfect informations, and the value of information is something called as the improvement in return if additional information is required, and perfect information tell us with certainty which outcome will occur. Then finally, EVPI, that is the expected value of perfect information, that is it is expected monetary value, that is called as EMV, with the perfect information minus the EMV without it, right. So, the expected opportunity loss is the average additional amount the investor would have achieved if the correct decision had been made. So, that means what I like to say, it is a decision making process. So, corresponding to various alternatives and different situation. So, we have a plenty of flexible outcomes. A particular outcome we have to pick up which can address the business problem or the make the decision making process more effective. That means technically our management decision should be very effective corresponding to the particular business problem. That is why we are discussing various tools and the kind of techniques, the kind of structure through which the decision should not be something called as wrong. So, it should be correct specifications, correct identifications, that too as per the particular business requirement. So, any misjudgment or the kind of any kind of lagging, so the entire decision making process will be ineffective. So, as a result the business problems cannot be addressed as per the particular requirement. So, the corresponding to the concept called as expected value of perfect information. So, we have a concept called as expected opportunity loss, which is the average additional amount the investor would have achieved if the correct decision had been made. So, that means technically, so if the decision is correct, then by default there is no problem. So, obviously everything will be in the correct space, correct requirement, but the structure is that if any wrong decision, then the entire decision making process will fail. So, that is how we must be very careful how to address this business problems, how to pick up a particular outcome, what kind of technique which you have to use, so that the particular decision making process will be very efficient and very correct one. The thing is that we have a different criteria corresponding to different alternatives and different situation, and we find different criteria gives different kind of results. So, that is why, so when we pick up a particular outcome to address the business problem, it is better to go through these problems or to analyze this problem with the more than one technique. Then we like to check whether the particular outcome is a kind of having consistency. So, that means this is a kind of robustness. So, if you say that this particular outcome is the best corresponding to various other alternatives which can address the business problem more effectively, then by default, so this should be also consistent with other different techniques. Of course, the objective must be or the criteria must be very consistent when in the process of management decision. So, then after having the kind of flexibility, the kind of situations, then the kind of outcomes, then we have to apply a particular technique and pick up a particular outcome which can address the business problem more effectively. So, that is how the value of information is very accurate, and for to highlight this particular concept, we try to connect the same examples. So, the example is with respect to decision making of 3 different financial investment, and that to 3 different situations. So, as a result we have a 9 different possible outcomes. One particular outcome need to be targeted, which can address the business problems as per the particular requirement or the kind of need. So, here we start with opportunity loss strategy. So, where the idea is that we have to find out minimum among all the columns individually. So, then we try to subtract the minimum element against all elements in that particular column. As a result, the particular matrix will transfer into this matrix. Then after that we try to find out expected opportunity loss. So, for that we try to find out actually means we try to connect these opportunity loss with the corresponding probability. Then we find out EVPI, that the expected value kind of opportunity loss. So, that means technically, so in this case we have 6476, and that need to be connected with the corresponding probability 0.6, which can generate 3885.6. and similarly, in the case of 3-year ARM, we have 2243, we have 4632, and we have 6560. So, this multiplied by 0.6, this multiplied by 0.3, this multiplied by 0.1. So, this will give you this much. So, that means it is nothing but kind of weighted average of all these 3 possible outcomes against 3-year ARM. Similarly, against 30-year fixed, we have 2 different outcomes, and that to 8215 against 0.3, and then 14497 against 0.1. So, this will give you the average figure 3914.2. So, then we try to apply some technique, maximization technique or minimization technique to find out which one is the final one to address this business problem. So, that means the EVPI is the typical structure through which we can actually try to bring a kind of or outcome, means to find out a particular outcome level through which you can take come with a kind of effective management decision, and that too as per the typical problem requirement. So, the thing is that the best decision will be here. So, let us assume that this is the minimum criteria which you can apply here. So, this is the minimum of first columns, and this is the minimum of second column, and this is the minimum of third column, and then we have already expected payoff. So, this is nothing but actually this multiplied by this probability, this multiplied by this probability, and again this multiplied by this probability. So, we will have this first this is expected payoff against 1-year ARM, and this is expected payoff for 3-year ARM, and then this is expected payoff for 30-year fixed. Then the best decision will be the minimum of each column against rate increase, rate stables, and rates fall, and then finally the difference is equal to EVPI, which is nothing but actually 3391.40. So, that means technically the family should not pay more than 3391.4 for any information about the future interest interest, no matter how good, whether it is the kind of 1 year RM, 3 year RM or 30 year fixed. So, that means technically, so it is a kind of effective kind of scenario through which we can address the business problem more effectively as per the business need or the business requirement. So, the value of information is nothing but decision with the sample information. The sample information is that the results of conducting some type of experiment. Obviously, it is a kind of an experimental process, and examples includes like marketing research studies or interviewing experts. So, sample information is always imperfect and sometimes comes at a cost, and the expected value of sample information is the EMB of the outcome with sample information minus the EMB without it. So, that is how the process which you have already derived here. So, that is the summary which you have addressed here, and in order to address the value of information more effectively, more accurately. So, we can start with another examples. A company is developing a new cell phones and currently has 2 models under the consideration, and 70% of their new phones have high consumers demands and 30% have low consumers demand. So, that means we have 2 different alternatives, and then model 1 these are the input descriptions, and model 2 these are the input descriptions. In the model 1 the investment requirement is $200,000, and in the model 2 case it is $175,000 investment. So, we in both the cases there are 2 different kind of structure. One particular structure is called as a demand is high, and second one is the demand low. So, that means we can have a decision tree having 2 different branches. So, model 1, model 2, and against model 1 we have high demand, low demand. Again model 2 we have high demand and low demand, and of course, the possible outcomes are already given here, and then we like to check which particular feasibility is the best for this particular requirement. And for that we can use this particular value of information to take the decisions and then apply as per the particular requirement. So, what I have mentioned, we can actually have a decision tree. So, this is model 1 and model 2, each case we have 2 different nodes with high demand and low demand, again model 2 with high demand and low demand, and these are all possible outcomes, and then finally we can find out a expected value, and then we can so ultimately we have 4 different outcomes. So, we have to pick up a particular outcome which can address this business problem more accurately. So, that is how the EVPI structure or the kind of need through which you can actually deal this business, and continue with similar kind of structure. So, here the some more information can be connected, and then the output can the output levels or the outcomes levels can be expanded. So, that means there will be more number of flexibility if you put further constraints, and the moment you put further constraints, then obviously because it is a uncertain kind of environment, we have again probability. So, that means slowly the value of output will be reduced, then finally we have to take a kind of decisions, like it's completely like BBM which we have discussed in the case of prescriptive analytics. So, depending upon the kind of situation, we have a different kind of branching, and under each branchings we have a different kind of alternatives and the kind of options through which the particular outcome can be generated, and then our job is to find out which particular outcome is the best requirement for the business need or the business requirement. So, the best structure through which you can analyze this problem is through Bayes theorem, and here it is the question of conditional probability, because our particular target is there. For instance, the general form of Bayes theorem is like this. So, here we have actually this is the general structure of Bayes theorem. So, we need actually probability of A given B means. So, we try to target a particular node corresponding to the a condition of other node. For instance, model 1 high demand. So, the model 1 high demand means this is how the conditional issue, and then we are trying to find out what is the expected fare for with model 1 then high demand, model 1 with low demand, similarly model 2 with high demand, model 2 with low demand. So, likewise we have a different kind of structure. So, that means this will extend depending upon the number of constraints. So, now in this case we have a two different structures. So, low demand and high demand, and low market survey response and high market survey response. Then we try to prepare a decision tree corresponding to this information, and the final choice about a particular requirement depends upon the Bayes theorem requirement. So, that means technically having these informations we have a different level of outcomes, and the high demand, the probability of high demand is 0.70, probability of low demand is 0.30. So, now probability of one particular conditional case is 0.90, another particular condition is by default 0.10. So, this means there is a high demand, market demand, and low market demand, and that means technically if you go to this particular structure. So, that means L stands for low demand, S stands for high demand. So, DL stands for low demand, TS stands for high demand. So, ML stands for low market survey, MS stands for high market survey. So, accordingly, so the conditional probability is like this high market, this is actually high market corresponding to high demand, and that the probability is 0.90, and then high market corresponding to low demand, that is 0.20. Since total probability is equal to 1, so against high market with high demand, if it is 0.90, by default low market with high demand by default will be 0.10, that is 1 minus 0.90. And similarly, in the case of high market with low demand, if it is 0.20, then low market with low demand. So, this will be 0.80. So, that means how total probability always equal to 1. So, if you prepare a kind of payoff matrix, so the row wise summation and column wise summation exactly equal to 1. So, that the typical structure can be addressed more effectively, and as corresponding to this one. So, we can derive a probability of high demand against high market structure. So, this is the conditional probability structure which is coming actually 0.913, and similarly probability of low demand against a high market. So, by default it is 1 minus 0.913. Similarly, probability of high demand against low market conditions, so which is coming actually through conditional probability, that is 0.226. By default probability of low demand against low market, so that will be 1 minus 0.226, that is 0.774. So, that means, so the value of informations connecting to this particular business deal with respect to various alternatives and situations can be effectively addressed through value of information concept, and then it will be more accurately addressed with the help of Bayes theorem. So, now the final requirement is actually to compute conditional probability, that is how the high market demand. So, which is nothing but a high market demand with high demand multiplied by a probability of high demand. Similarly, probability of a high market with low demand against low demand multiplied by probability of low demand. So, this is coming altogether 0.9, and similarly a probability of low market is nothing but probability of low market against high demand multiplied by probability of high demand. Similarly, probability of low market with low demand multiplied by probability of low demand, that is coming actually 0.13. So, this is actually it is a mixture of conditional probability, marginal probability, and the joint probability. That is how the Bayes theorem is all about. And the decision making process which we have discussed till now is a kind of conditional structures, and it is exclusively the kind of connections through which various nodes are connected. So here if you like to analyze a particular situations with respect to different flexibility alternatives and the kind of situation, you will find it is the connection of connection of joint probability, marginal probability and conditional probability, because all these nodes and the kind of outcomes are connected with the various levels of probability. So accordingly when you need a particular requirement, then by default the issue of conditional or the situation of conditional probability will be coming into the picture. Then you have to analyze as per the particular requirement. So applying the conditional probability, you can get to know what is the particular level of outcome through which the particular business problem is more effective. So that means so there will be the kind of situation where we have a various alternatives depending upon the kind of flexibility and the kind of situations, and then we pick up a particular outcomes with respect to the business need. For instance, here the need is the prediction about high market, probability of high market, and with the help of whatever informations, that is probability of high demand, probability of low demand, probability of high market share, probability of low market share, then the joint probability. So that means technically we have a some kind of inputs, inbuilt inputs, and then we can analyze the particular situation and then come with a particular level of outcome where we can address the business issue more effectively, and then come with a kind of management decision as per the particular requirement. So likewise, this is how the summary sheet we have all these kind of conditional kind of situation, and through which you can address the business problem. And likewise, what we can do, we can prepare a decision decision tree depending upon the different situations where we start with simple here the kind of structures. Let us say this is the first hand decision structure, and then the particular classification, high survey response, low survey response, model 1, model 2, again model 1, model 2 with high demand, low demand, high demand, low demand. So that means depending upon different cluster and structuring, we will have a different kind of options, and every options will give you some kind of output and which can address the business problem more effectively. So that is how the value of information can be considered as a as an effective tools to address the business problems and come with a management decision through which you can generalize the situation, and then you can indicate some kind of strategy through which you can forecast the business problem more effectively. This is another problem, so connecting to this value of informations, and corresponding to the value of information, the next component which you can connect to this decision analytic is utility theory, and how utility theory can be applied in the decision making process, and that too under the decision analytics structure. First of all, what is exactly the utility theory? The degree means it is the degree of pleasures or displeasure a decision makers has in being involved in the outcome selection process given the risks and opportunities available. So that means we since in the question it is a question of utility, so there is a issue of satisfaction and dissatisfactions, and we have a different level of outcomes depending upon the risks, uncertainty, then the kind of alternatives, different situations, and any particular outcomes which may give satisfaction to the decision makers may not give satisfaction to the decision makers. So that means we have different options where the decision makers will be satisfied and not satisfied, and because ultimately it is not in your hand. So it typically depends upon the business environment and the kind of situations and the alternatives. So under the particular situations and alternatives, we have to find out what is the kind of expected outcome corresponding to the business problem, and then we come with a kind of decision. So, there are three different utility decision corresponding to the risk and opportunities. So, risk avoiders, risk neutral and risk taker. So, that means these are all different kind of structuring in the utility theory, and that too in the decision making process. So, what I have mentioned utility theory is an approach for assessing risk attitudes in a quantitative way. An individual's utility function reflects the preference towards this risk, and the risk premium is the payoff amount that an individual is willing to forego to avoid the risk. And then finally, the break even probability is the point at which an individual is indifferent between a guaranteed payoff and taking a gamble for a higher payoff. And the certainty equivalent is the amount an individual feel is equivalent to the payoff from an uncertain gambling. So, that means it is a kind of flexible kind of structure through which you will find different level of outcomes, where one way you try to satisfy the decision makers, and through which you are searching the kind of outcomes which can deal the business problem more effectively. And to understand this, we can start with a simple example here, and it is a personal investment decision. Suppose you have 10,000 to invest in the short runs, and that too you have three different options. So, bank CD, bank fund, bond fund and stock fund, and as a result we have three different options: rates increase, rates stables and rates fall. So, under each case we have a different return, and some it is average returns, and then so we have here 400 minus 500 and 900. So, that means technically we have the payoff matrix corresponding to these different options and the kind of investment plans. So, now we like to see how the outcome is will be used, and the kind of structure you have to bring, so that the decision will be very effective as per the particular requirement. So, so what will we do? We try to construct a utility functions here. It is another kind of personal investment decisions, where we like to assign a utility to the highest payoff, where we can put u of x equal to 1, and assign utility to the lowest payoff where u of x equal to 0. So, as a result, so if you put 1700, that is the highest payoff, then this will be utility 1, and against the lowest payoff is here minus 900. So, the utility of minus 900 equal to 0. So, that means we need some kind of quantifications, because it is a utility is a kind of qualitative concept. So, we need some kind of quantification to address the problems, and then come with a kind of decision which can satisfy the decision makers as per the particular business requirement. So, ultimately, so this is a kind of structure through which you can analyze, and similarly, so the entire structure again can be addressed through a decision tree, and here the investment structure will be like this. So, this is actually starting node, and it has two different kind of options, and the first option is with take a chance and guaranteed returns. So, that is how the risks will be appearing here, and as a result we have two different options. In one case we have 85%, another case we have a 15%. So, as a result we have two different levels of output, and corresponding expected value is like this, and here also expected levels corresponding to the loss 15%, and then again here in the guaranteed returns we have a expected pay. So, then finally, we have three different levels of outcome, and we can apply the conditional outcomes, or we can try to find out which one is the best outcome with respect to all possible outcome, and that too for this personal investment decision. So, likewise we have a different kind of structure through which we address this business problems as per the particular requirement. So, this is how corresponding to the previous examples. Now, we have analyzed in the case of utility, highest utility and lowest utility, but in the meantime if we apply all these values, so we can find out the utility level in between, and then expected payoff, risk premium, then finally the break even probability. So, now if you plot these, then you will find the kind of structure will be like this. So, so this will be the kind of neutrality options, and this is corresponding to the actual happenings. That means the kind of situation where risk premium is greater than 0, that means utility of x is greater than to risk neutral, and look like concave function, and that means the decision is not actually in a kind of linear shape. Technically yes, there is increasing, but the kind of increase is a little bit ups and downs. So, ultimately it depends upon the kind of situation to situations, and that too with business environment. So, this is how the entire utility functions, and again in this case the risk premiums is less than 0. So, that means the utility of x is less than break even probability, and as a result the structure will be concave type of situation. So, now corresponding to these problems. So, what we can do here. So, we have again a kind of problems where we have 3 different alternatives. So, the bank CD, bank bond fund, then stock fund as per the previous examples, and again we have actually outcomes corresponding to rate increase, stable rate and rate decrease, and then we can find out the average utility and find out to the maximum of average utility. Similarly, if we apply the expected value concept, then again so we can find out a average payoff corresponding to the particular probability, and then we have to take a decision which can give you more effective result. For instance, out of these 3, so we can actually choose the particular one which is nothing but $467 compared to 400 and 447. So, that means actually, so these are the various mechanisms through which you can give you better understanding or the kind of better clue to find out a particular level of outcomes through which you can address the business problem more effectively. So, these are all various different kind of requirement, and again if you start with the kind of structure of the utility functions, you will find corresponding to this utility function you have actually different kind of structure where the shape of parameter is indicative of risk tolerance, and smaller the value of r have a more concave of utility function, and as a result there is more risk aversion in nature. So, now so these are the typical kind of examples through which the utility function can be analyzed. So, now here in the another examples, the same personal investment where the utility function is nothing but exponential type, and against corresponding to these various payoffs we have a utility, and against the utility we have a different kind of decision making process depending upon 3 different investment plans, a bank CD, a bond fund and the stock fund, and then different rates increase, rates stables and rates falls, and then finally you can find out the average and then take the decision. Since here the best average is 0.632 corresponding to the minus 0.2316 and minus 2.2417. So, that means technically this can be the best outcomes so far as this personal investment decision is concerned. And likewise actually, so in practice, that is an analytic practice, using decision analysis is a very practical kind of or very accurate kind of process through which we can bring the different level of outcomes with respect to different alternatives and different situation, and this will give you some kind of flexibility to the business problems and to the decision making process, and the decision makers rule is to find out which particular outcome is very effective with respect to a particular condition or with respect to a particular requirement. So, that means the decision tree or the kind of decision analytics will give you some kind of more flexibility corresponding to different situations and different requirement, and so that means technically we have a different level of outcomes depending upon the particular alternative, depending upon a particular situation and the kind of criteria. And so we can pick up, or the decision makers can pick up a particular outcome to address the business problems as per the the typical requirement. For instance, if you have a 3 alternative corresponding to a particular alternative with a particular options, you can strictly pick up a particular outcome which can address the business problem more effectively. So that means technical, this is another problem through which we can address the business problem more effectively. So that means technically, if you connect with the kind of utility theory corresponding to the decision analytics, so there are 3 different options, behaviors. So the line which we have here is called as risk neutral, and this is actually a risk takers, that is the convexity of this particular utility functions, and risk avoider, it is a kind of concavity of the particular utility functions. So that means technically, so these are the various natures of utility functions corresponding to a particular business problem. And what we have already mentioned, we use typically Bayes theorems to address this kind of problems and deal with the business problems which can generate some kind of better results as per the particular requirement. So now we can start, we can connect with this with another examples. Here we have 2 different financial instruments, bonds and stocks, and we have 2 different situations, no growth and rapid growth. So then in the no growth situation, we put the, or we assign the probability 0.65, and in the case of rapid growth, we are putting the probability of 0.35. Then corresponding to 2 different financial instruments and 2 different situations, by default we have 4 different outcomes. These are all these are all here 500, 200, then 100 and 1100. So these are all so that means now we have here the kind of conditional kind of things. That means if you like to choose the option of bond with no growth situation, then the outcome will be 500, and again if you choose stocks with no growth, then the outcome will be 200. So likewise we have a different options and flexibility to address this kind of business problems, and then come with a kind of decision making through which we can analyze the particular business problem more effectively. And likewise, so what we can do, so corresponding to these inputs, input matrix, so we have a different criteria against to apply and then to analyze the problem. So if you go by simply kind of expected manually criterions, then corresponding to this probability, just you can find out the expected value, and since it is a kind of investment decisions where you will get highest expected value, so that will be the final choice. Then here with respect to bonds, we have 2 different options, and stocks we have 2 different options. So obviously if there is a choice between bonds and stocks, then the first hand choice will be the the investment should be in the bond side, and that will generate here in this case $360. So likewise we have a different options, and that to address this particular business problem, and this is how the decision tree can analyze more effectively. And corresponding to this outputs, so what will you have, we can prepare a decision tree which you have actually bonds and stocks, and against bonds we have 2 different options, growth and rapid growth. Similarly for stocks we have a no growth and rapid growth, and accordingly, so against bonds no growth we have outcome 500, again bonds with rapid growth we have outcome 100, then again stocks with the rapid growth, that is 1100, stocks with no growth which have minus 200. Now having different probability, so you can find out the expected value and then try to find out which particular outcome under different situations. So likewise different probability we have, and then we can analyze the situation. This is another kind of structure through which you can address this particular business problem. Same Bayes theorems can be applied to try to explore the different possibilities depending upon the different situations, and which we have already discussed corresponding to the previous problems. So, now we have actually two different situations, and then again corresponding to the different financial investments. So, we have some kind of a joint structure and conditional structure through which you can address the business problem. So, that means in order to justify this one, so this will be the another kind of structure here. So, the no growth situation and the growth situation. So, that means technically, so this is how the investment structure, where this is the no growth situation and this is growth situation, then bonds and stocks, again bonds and stocks, again here no growth situation, rapid growth situation, again no growth situation, rapid growth situation. So, likewise we have a different options, and that means the whole idea is actually the we like to know that different option we have to address this business problem, and that means technically the particular structure gives a different kind of options through which you can address the business problem more accurately. That means technically in the decision analytics we have already discussed various tools and techniques and the kind of criteria through which we can bring different levels of outcome depending upon the various alternatives and various constraints, and then we can try to select a particular outcome as per the particular business objective or particular business requirement. In sum, we have discussed various analytics structures, starting with the descriptive analytics, predictive analytics, prescriptive analytics and decision analytics, and under each heads we have discussed various techniques, tools and connected with the various business problems, and then we try to find out how the business problem can be addressed, and we try to find out various alternatives, and against each alternatives we try to bring the sensitivity structure, robustness structures. So, that means what I like to say that business analytics is a kind of tool baskets, where we have a plenty of analytics tools through which we can analyze a business problem as per the particular business requirement. So, depending upon the problem, depending upon the particular requirement, the need is that we try to find out various alternatives in the process of robustness, in the process of simulation, in the process of sensitivity structure. Then that means technically we try to extract as much as possible information to address the business problem more effectively. So, that means if I like to summarize, so the business analytics is a kind of tool baskets, where we have a plenty of business analytics tools, and that too we can apply as per the particular business requirement. And then if a particular tool is very perfect as per the particular business requirement, then we come with a kind of outcome which can address the business problem more effectively, more efficiently, more accurately. Then we can apply the management decision as per the particular management requirement. With this we will stop here. Thank you very much. Have a nice day.